Well, let's get to some of the potential risks that are associated with senior bridge loans
Sure.
and how can seniors and their families mitigate those risks when considering this as a finance option?
So when you take on this additional debt, when you've already moved into the community, you now have the bridge loan payment. You still have your taxes and insurance and maybe HOA fees, depending on if there are any on your current home. And now
Mhm.
you've also started to incur your monthly rent for the community that you're living in. So you're basically more or less doubling your expenses. So that's the financial risk. That what we do to mitigate that is part of our conversation with the seniors and their families is to determine if we should be cashing out extra money to cover the payments in case the home doesn't sell right away.
Now, you mentioned that some of the bridge loans, they do like a deferral payment, so you can have a period of time where you don't have to 3 to 6 to 12 months even, where you don't have to make a payment. Are they accruing interest all that time? Do they make interest payments during that
They
time?
typically do, yes.
Okay.
And there's different programs that have different approaches to how they do that, but
Hmm.
you're generally still accruing interest. It's just a
Right.
matter of whether you have to make an out-of-pocket payment.
Okay.
And the ones that don't have a payment associated, from a lender's perspective, they're riskier. So if you have the financial wherewithal to continue covering that payment for a year, 2 years, 5 years, whatever it may be,
Hmm.
you're inherently reducing the risk that you could run into a problem. Or if you end up having to sell the home for less than you anticipated, or you want to wait out a market.
What safeguards or protections are in place to ensure that seniors and their families are not burdened with overwhelming debt when using a senior bridge loan?
Mhm. It all has to do with how much capital they have available in
Okay.
case that home doesn't sell as quickly as they anticipate.
Okay.
So if you have the financial wherewithal to continue covering that payment for a year, 2 years, 5 years, whatever it may be,
Hmm.
you're inherently reducing the risk that you could run into a problem. Or if you end up having to sell the home for less than you anticipated, or you want to wait out a market.
Yeah.
Um, so the terms can be very similar. Where you see the difference between a traditional loan and a bridge loan is
Hmm.
usually in the fees. So most bridge loans carry origination fees of 2 to 3% of the loan amount. And the reason why, if you flip it and look at it from a bank's perspective, if a bank is lending $500,000 for 10 days in that extreme example, it's
Hmm.
not worth it for the lender to go through the whole process of originating the loan, processing it. They're just not going to make enough interest on it to justify. So short-term loans often have these origination fees,
Yeah.
because that's how the banks make money, is off of the fees, not off of the interest so much.